Happy Monday. It's 1:20, August 24th, and I wanted to go over a few trades that we looked at last week. If you remember, you can reference a previous video, but we we bought the FOB spread. That's the 5 against the 30-year. Well, it's actually the 20-year, but I know I keep repeating that, but it's worth knowing that the ZB actually has a 20-year average maturity. You can see that in the indicative portfolio in the CME website. The true 30-year is the UB. That's the ultra bond, but we don't trade that because of liquidity, right? So if you remember, we shorted the ZB. I know some of you might say, well, yeah, it's easy to say after the fact, but we have a live video. Closed that last week in a real account. We closed it in the SIM account that I'm going to show you here in a minute. So it was about a $600 trade. So we shorted the ZB because the ZB was expensive, and long the ZF because the ZF was rich. ZB, that's on a 3-to-1 ratio. Okay, now I want to show you something else. This is a brand new feature as well. So what you can do is get a real good view of all the outrights. Okay, and this is based on P&L. So it's easy for you to see which is expensive. What you want to do is you want to click this as well. This is the ratio weighted P&L. Okay, so what it's doing is it's taking the CME ratios and it's determining what would have performed, how it would have performed. With real money, you can see what's truly cheap and expensive. So that changes the perspective, doesn't it? So the ZT is the most expensive today, all right, and the ZN is the cheapest. Now, if you look over here, this was from the 20th. Remember, we shorted the ZB. This is on a ratio weighted basis, so this is more accurate. All right, so you can see over here, we shorted the ZB and we went long the oh man, sorry about that, guys. Everything just updated, so it's funky. So anyway, over here, 584, you can see we lost about $500 on this trade, and then 1190 all the way down to, made almost a little under 1,000 here. So that's where I said it was about a $500 trade. All right, and now you can see bonds are mixed. Stay away. Now I want to show you another trade that we did. If you remember, the TUT spread. All right, why did we trade the TUT spread? The TUT is the 2 and the 10. All right, so we went long the 10. We take a look at what's expensive. Remember, we get guidance over here. So we went long the ZN, short the ZT. Let's look at it. Long the ZN. Okay, up 1,800 now. Short the ZT, down 156. Okay, this isn't candlesticks. This isn't, indicators. This is a true relationship. When you see what's cheap and you see what's rich, you act based on that because of this is the yield curve. What are we looking for here? We're looking for a condition. Is it steepening? Is it flattening? So everything right now is steepening. Right, so the longer maturities should fall in price, right? Because if they go up in yield, this will fall in price. So that was a relatively simple, straightforward trade. You get the guidance right here. Long the ZN, short the ZT. Now the number 2 trade is long the ZN, again, short the ZB, which makes sense, doesn't it? Because if the yield curve is steepening, that means the longer maturities will fall in price. Okay, so we're going to hang on. We're going to stay with that trade for maybe just another day or two or see how it develops, because the longer term is the yield curve, but within that, those gyrations, out of balance conditions, this could be hedging. This could be part of a spread leg for a big institution, a desk that trades for a mortgage lender or an auto lender or a pension fund or pension fund asset manager. This is where trade opportunities exist. Try to think of it in terms of if the trend on stock or a currency or a futures contract that you're trading is trending up, you're going to look for short-term sell-offs to fade the trade. It's kind of the same principle, but what you're looking for are short-term imbalances between maturities. What does our tool do? It's constantly measuring it. It's constantly looking for opportunity. Here, let's find a couple. Okay, here, ZB, rich. Down here, ZT. I wouldn't necessarily trade that because this is a long maturity window. Perhaps I would sell the ZN, perhaps I would sell the ZB in this scenario right here and buy the ZN or buy the ZF, which is the 5-year. So I can trade the 5-year. What am I doing? I'm selling what's expensive. I'm buying what's cheap. Now, this is actually consistent with what's going on in the yield curve, isn't it? Because if the yield curve is turning higher, okay, here's an opportunity to sell this and buy this. Sell the longer term maturity, buy the shorter term maturity. Pardon that, guys. Squared away. Let's just look at another one. Here's another one. This was the TN. Okay, that's the ultra 10-year. What am I going to do? I'm going to sell the 10-year, but since the yield curve is steepening, this makes sense. What am I going to buy? I'm going to want to buy a shorter term maturity. There's one right there. There's the ZT. So I'm going to sell what's rich, buy what's expensive, wait for it to come back into equilibrium. When I say equilibrium, I also mean equilibrium in a way that's consistent with this. All right, Bond Desk, it gave us an indication already. Long the ZN, short the ZT. It's what happened over here. Long ZN, short ZT, and nice trade there. 1700. You know what? This is Sim, so let's just go ahead and close it. All right, let's put 20. I'm going to try to pick off a better fill here. All right. I'm going to see which one gets filled first, and then whatever one gets filled first, then I'm just going to close the other one, exited market, and
Order
cancel.
filled.
There you go.
Order filled.
I'm out. Let's see what the... Again, guys, I don't want to come off like this is a no-brainer trade. This is easy, cha-ching with every trade. But it is really easier, and it's more logical, and it's very intuitive. All right, guys, that's it for this video. Before I sign off, I just want to make mention of one thing, and it's just really another reason why you might want to consider trading bonds if you're not already. A big one's liquidity. I want you to take a look at this. What I did is I put the ES here, and I put the volume, the liquidity, up against ZT and the ZN, the 2-year and the 10-year. Okay, two very actively traded contracts. Take a look at the offer, the size, right now at the offer, the size that traded at the current offer, 108,150. That's 228,000 contracts. That's a liquid market. Over here in the ZT, the current offer, 168,000. And then over in the ES, and the ES is not it's a heavily traded contract. Look at this, 11,000, 8,400. All right, up here we had 14,000, but that's pale in comparison to 168 and 228,000, isn't it? So you have a very liquid market. Another thing is here on the ES, your price per tick is $12.50, isn't it? Over here it's 15 5/8. 15.625, and on the ZB it's 31 1/4. So you get a lot for your buck, even though the movement, the range isn't as great. Obviously, look at the range on the ES. Okay, even though the range isn't as great, it's a very professional market. And look, it's your money, it's your account. You trade whatever you're comfortable with. At the end of the day, everybody's going to trade what they gravitate towards. But I think it's once you start trading bonds, at least adding them to your symbol list, let's call it, I think you'll see how much easier it is, how much it lowers your blood pressure, especially when you're trading bond spreads, and how logical it is. I'm going to show you this over here. Almost every day, 4, 5, sometimes 6 out of the top 10 of the most actively traded futures contracts are in the bond complex. Look at right now, the ZT, it's a 2-year, okay, the 10-year, 5-year. So the top 3 positions are the 2, 10s, and 5s. All right. And then isn't that interesting how much ground the micros have made? The number 4 is the NASDAQ micro, the MNQ. And then number 5, surprise, surprise, it's the bonds. So we'll see 1, 2, 3, 4, 5, 6. 5 of the top 6, 6 of the top 7, 6 of the top 8 are the bonds. So it's very actively traded. The volume's high. It's very liquid. I can't emphasize how important it is to make sure that you're trading a liquid instrument. We've left a link in the descriptions. If you're ready to get started with bond spreads, you can sign up down there. if that's something you want to do or improve upon, make sure you mention that, and we'll cover that in your free onboarding as well. All right, talk to you then.